So again, to me, I've known Tom for quite some time. I think probably since about 3 months after he became CEO of Bankrate. But just to give a little bit of sort of bio background for everybody in the room, so started out as a traditional media guy at U.S. News and World Report back in the 90s, 7-year tenure there. You see the bullet here about highest ad revenue in the 70-year history for 4 consecutive years. For those in AdTech sales, you know that I'm sure that it was no easier then than it is now. So I'm a firm believer that a good sales-oriented guy goes a long way, and I think that goes back to his early days. Took GeoCities public, and probably can have some fun talking about that a little bit. So took it public in 1998 at a $1.1 billion valuation and sold it in May of 1999 to Yahoo for $4.6 billion, right in the height of the bubble. Took a little sidetrack stint in payments, which we'll talk about in a second, and then joined Bankrate in 2004 and just recently retired in December. So we're going to take a minute to give you a little bit of history on the Bankrate story, and again, I think you'll see why we thought this would be a very interesting fireside chat to do. So pre-IPO, Bankrate was started in 1976 as the publisher of the Bankrate Monitor, and basically aggregated mortgage information offline and sold it into newspapers. And then in 1996, the business sort of went digital, went public in kind of, again, the height of the bubble, and went public in 1999, and as you can see, promptly went from $13 a share to 19 cents a share. And so that was sort of all post-IPO, pre-Tom. Tom got on board and sort of turned around the company. So started with a $130 million market cap, took it private in June or July of 2009 at a $545 million market cap. So if you had invested, before the fall from 2008 to 2009, you would have, it was up 700%. If you had invested through the buy up 300%, took it private for 13 months, bought 2 key acquisitions to get into new verticals, NetQuote into insurance, and credit cards obviously into credit cards. So spent about $350 million roughly in terms of those 2 deals. Took it back out at $1.5 billion valuation in, again, 13 months. And then continued the acquisition trail, and again, recently retired in December of 2013. So if you had just put your pennies in Bankrate when he became CEO in 2004, held him to December when he retired, you would have made 13 times your money. Now, in the backdrop of well, gosh, I can start some app company and make $3 billion in 2 years, you think, well, maybe that's who cares? But this is kind of the hard way. This is maybe the old-fashioned way. And I thought it would be sort of a good segue in terms of lots to talk about. So that's a little bit of the backdrop. And now I'm going to scoot over there, and we'll have a little chat. So while I'm getting...
The easy way, too.
Oops. So first of all, Tom, do you think we're in a bubble? What's your view on that little commentary?
Yes and no. So I don't think we're in a bubble. I think there are some, obviously, fully priced companies. I think that are great companies. They're great companies. They're great businesses. They're great platforms. A Google, a LinkedIn, a Facebook. I think there are other companies. I mean, those companies certainly are priced at a premium and priced to perform over the next couple of years. But I think there are another wave of companies that are great companies that are growing. I'm on the board of a company called Shutterstock, which has been a very successful company, very successful IPO. It's a great product, and it's growing at 40% a year with 25% EBITDA margins, and it looks like it'll continue to grow at that level. So that's fully priced, but not sort of out there in the ozone. I think there are some other companies that haven't proven that they're businesses yet. They may be great products. TBD whether they're companies, and TBD whether they're businesses or not. And I think some of those are surfing along in this current environment. And I don't think it's a bubble. I think over the course of a couple of years, all of that will sort of work out. But having taken 3 companies public, it takes a couple of years for the public market to sort of catch up with the reality of the company. And I mean that good and bad. You've got to watch the team perform. You've got to watch the business trajectory. If you come out public and the company's growing at 30% a year, is that sustainable longer term? Or is that just sort of an opportunistic take public? So I think a lot of these things are going to be decided over the course of the next couple of years, but it's a very different environment than it was in 98, 99, 2000.
So talk a little bit about, let's start back there for a second. So talk a little bit.
The good old days.
There you go, the GeoCities story. So like what's the good and the bad and the ugly out of that? I know it was a long time ago, but still, that's exciting, right?
Well, it was great fun. I mean, coming out of traditional publishing, coming into GeoCities, I took over from the founder really to come in, build up the staff, make a business out of it, and take the company public, and we did those things. The thing that made GeoCities unique, there were about 5 or 6 community sites, personal publishing sites at the time. GeoCities was by far and away the largest, scaling the fastest, and had the most engagement, had the most users, the most traffic, dramatically more than the 2nd, 3rd, 4th, or 5th players, and started ramping revenue. And Yahoo decided at that time they wanted to acquire the company. It really was sort of a combination of a couple things. First of all, we went from about 1,800 to 3,000 to 18,000, I don't say uniques a day, people coming in and signing up and creating at least a homepage, a web page, a website. So this is not just people flying by. This is people actually coming in, using the HTML editor, creating a site and publishing that. And about 18,000 new sites a day. So it was growing massively. It went from being, when I got to the company, and I take a little credit for this, the 8th most trafficked site on the internet to the 3rd most trafficked site of the internet. So Yahoo, AOL, MSN, Excited Home, if you remember that, InfoSeek, if you remember that, looked at the asset and said, this is sort of a kingmaker. Whoever acquires this company and bolts it to their traffic instantly becomes the #1 site. Any of the top 5 who'd acquired GeoCities instantly becomes the #1 site. And so Yahoo thought that was what they wanted to do, and it was a stock swap for 10% of Yahoo. So GeoCities was sold for $4.6 billion because the market cap at the time at Yahoo was $46 billion. That's sort of how that all happened. And they did well with the asset for the period of time that they sort of managed it and monitored it. They really used it for traffic. There were a lot of things that they could have done with this is sort of a story about acquisitions. Had they left the team in place, had they left the core sort of protoplasm of the company in place and allowed the company to continue to develop the business and the products and the ancillary things that were sort of on the product map, you could argue that it could have become the next YouTube. It could have become Facebook. It could have become a number of things. But they, listen, if somebody pays $4.5 billion, they can do whatever they want. But they just decided they were just going to use it for traffic because their business was selling display advertising, and that influx of traffic and that activity level by those consumers was something that benefited them greatly. It kind of atrophied over time. I think after 12 years, they finally kind of shut it down. But it served them well for what they wanted to do.
So, between GeoCities and Bankrate, you're sort of a, what's the right word? An expert in sort of consumer behavior in terms of what works and what doesn't work, and what does work, what doesn't work, what's changed when you think about when you built that audience back then, and obviously Bankrate, you watched a lot in terms of performance-based marketing. And
yeah, I say the biggest difference. There are 2 big differences at the time. The one thing about GeoCities that was unique, and that time was unique, and the reason that fell apart so quickly is it really was. I mean, the web and advertising on the web was really in an experimental phase. I mean, people took some money away from marketers took money away from direct marketing budgets, some out of advertising budgets, and there really wasn't a commitment. It was just testing, and so it was pretty movable whether they wanted to spend that money or not. And when the sort of the media crash of 2001 and 2 occurred, a lot of them pulled back, a lot of that marketing money. Very different today. There is there's a genuine commitment on the part of marketers that the web is where people are shopping for products. We have to market our products and services on the web. We have to be good at it, and we've got to be able to account for the money that we're spending and monitor and see what the ROI is on that money spent. Lynn and I were talking, there's sort of, two sort of schools of thought. Bankrate was unique in that people, I'd love to tell you Bankrate is so amusing and so interesting that people spend Saturday afternoon grooving around Bankrate rather than watching college football or doing something fun. They don't. People come to Bankrate when they're in market looking for a financial product, a mortgage, a refi, a credit card, insurance, a deposit, and they use the tools and they use the guides and they use the calculators and all the content that we've developed to make themselves smarter so they can make a smart decision about something that's actually a pretty big decision. If you're thinking about getting a mortgage, you can save yourself or cost yourself a lot of money by doing it right and wrong. Same thing with deposits, same thing with insurance and credit cards. And so you've got people who are in-market consumers shopping for products, and as a result, the conversion is very high. It's the only reason why I'm there. I'm laser focused on doing that, and so advertisers pay premium prices. I'm talking about $60, $80, $100, $100+ CPMs to advertise in that environment because there's no other reason why the consumer's there. They're learning about the product, they're researching it, or they're ready to buy. That's very different than trying to find somebody out on the web, on Facebook, at Yahoo, in Yahoo Mail, who may be interested in a mortgage. We're talking about very, very few people. So, one is very contextually oriented, right? I'm there for that reason. I'm shopping. Any ad, actually, an ad in that environment is like content. It augments the buying experience and my knowledge if the ads are done well and done properly. In a different environment, if somebody's on a gardening site, you've got to intercept them with that message. So that message is going to be worth a lot less. And that kind of inventory, non-contextual, non-relevant, is available by literally tens and tens of billions. And so that turns out more to be a commodity. And that's why you see the buy-side platforms and retargeting to try to give just that lift to make that $1 CPM worth $1.20. But you're never going to compete with the $80 CPMs and the $100 CPMs where you've got in-market consumers. So marketers know that, and they buy both, and they allocate their money depending upon what they're trying to achieve with the dollars that are being spent.
Did you find anything different between people that are shopping for a mortgage versus insurance policy versus credit card in terms of behavior or what's important vis-a-vis this question of in context?
Well, I would say yes and no. The behavior is similar for similar demographic groups. All right, the thing that we see a lot on Bankrate, and we see it every single day, and we see it across the different products, is if you can qualify. So the people in this room, it's never been better than it is now. Rates are low, marketers need you and want you, and they're willing to give you really great offers for cards, for insurance. It's very competitive for those people that can qualify. Yeah. The problem is who can qualify. Not everybody can qualify. And so what they're really trying to find, the marketers are trying to find, is that consumer who's in market who actually can qualify for that loan, who actually can qualify for that card, who actually have the money to make a $50,000 deposit. And so it's a little bit, it's separated by demographic, and we watch the demographics very closely. It's fascinating to watch, particularly in light of what we're talking about, trying to get the economy back to full employment. I'm not going to, it's not be a political commercial, but from what we see, we're doing all the opposite things that we should be doing as a country to get more people employed, more people in houses, more people accessing credit. We're actually making it tighter. All the new rules that have come out of the federal government, whether it's Dodd-Frank or the CFPB or any of that, has actually made it tougher for the marginal consumer to get a credit card, to get a loan, to refinance their home. As I said, the people in this room are doing great. The people that are at the margin are having a very difficult time. And I suspect we're not going to be doing a lot better nationally until we kind of help out those people in the middle. The people at the bottom, no offense, they're screwed. They're dead. They can't get a job, they can't get a credit, and there's nothing coming out of the, policy-wise that's really changing all that. So we got to help the people in the middle have access to credit, and I think it will be better for business, it would be better for the economy, it would be better for this country.
Is there anything else you see from a consumer behavior perspective, let's say, that's different today versus, say, 2008, 9-ish?
What we've seen, again, and I think you see this on a lot of different sites, whether it's Kayak or Bankrate or some of the tech sites, is that the consumer now wants and trusts a comparison shopping environment. We used to have, and particularly on the credit card side, the big issuers, and there were only, literally, 8 or 10 of them, they wanted everybody to go directly to their site. They wanted people to go to Citi.com, to AmericanExpress.com, to Chase.com, to BofA.com. They realize now that what the consumer wants, if the consumer's looking for a rewards card, let's say, a gold card, the consumer wants to be able to see all the gold cards side by side and see what the particular characteristics and offers of those cards are. And they want to know that that's available. They don't want to have to go site to site. And what's mind-boggling about it, and we've seen this in insurance, we've seen this in mortgage, we've seen this in credit card, and we hear from people in the travel industry, there's a similar pattern of behavior. It actually converts better being on comparison side. So if somebody comes to Bankrate, sees an American Express offer, clicks on that, goes and fills out the application, more people qualify, more people get approved than if they go directly to Amex.com. It's about 2 or 3 to 1, depending upon the card, depending upon the demography.
I found that amazing.
It's fascinating, but I think you get people who are at that point further down the funnel. They know what they qualify for. They really are able to determine what they want, and I think you see that. So the card issuers and the lenders and everybody else have gotten to the point where they're embracing. They don't love the competition, but they're embracing that platform, because they know it works, and they know, even more importantly, it's what the consumer wants.
Do you think the financial services sector is further ahead than some other verticals because you have these big ticket transactions and you're able to kind of follow consumer behavior, or no?
Yes and no. I'd say mortgage, which was one of the early, sort of adapters online, and Doug Lebda at Lending Tree sort of, started that company, and Bankrate was early into that business. Mortgage is very sophisticated. Mortgage, the lenders are very good at converting a mortgage customer online. Credit cards is very good. They know exactly the demography that they want. They know how to track those people. They know what offers move the needle. Insurance is mind-bogglingly behind the game. They're a decade behind, and we've got the largest, third-party insurance business in the country. And the carriers, they're trying to play catch up. They really didn't want people shopping for insurance. They really didn't want comparison. They wanted you to deal with your local agent. Your local agent was going to sell you a policy. You were going to auto renew. He was going to try to upsell you other things. If he had your car, he was going to sell you, property and casualty. He was going to sell you life when you had your first kid. They're now seeing with Progressive and Geico the fact that you can't swing a dead cat without seeing on television, if you shop, you can save, right? So what does that tell the consumer? There's a deal to be had out there, and it's having an impact on everybody, and everybody's having to compete as a result. But they're playing catch up from a technology standpoint. They're playing catch up from a targeting, and really understanding, how the consumer converts. They're a decade behind some of the other vertical categories that we participate in.
So that's interesting. So let's back up for a second. Was it totally miserable being the CEO of a baby public company? And how did you get Wall Street interested? How did you, when you think about that 04 to whatever 08, 09 period, how'd you really do that? Because just like the internet titans, transforming the business into, mobile. This is not easy to do, right? To take a $130 million market cap company and sort of make something of it. And I think at one point in time, you and Quinn Street sort of traded, even, and then you clearly traded a huge premium.
Is it miserable? No. Is it more work? No doubt about it. Does it make you change the way you manage the company? Absolutely. Anybody tells you otherwise is either Jeff Bezos, who has the luxury of just saying, "Here's what I'm going to do. You can buy into this or not," or but you have to pay attention. The hardest thing is to try to fit, your business in a nice little neat 90-day chunks. And then if you're out of position, you're never exactly where you want to be. It's either a little bit too good or it's just a little bit too shy, and you just have to communicate that. When I got to Bankrate, we didn't have a single analyst covering the company. When we took the company private in 2009, in the midst of the credit crisis, we had 21 analysts covering the company. So, it was going out and seeing people. It was telling the story. It was telling them why this was an interesting company to follow. We had grown the company from basically flat and declining to $58 million in EBITDA in 4 years. And so, there was interest in the company. And it's always been, it's been kind of a fascinating place to work because there's always been a great debate between, the people that think that we're a bellwether for finances and, and mortgage applications are down, it's got to be bad for Bankrate. Oh, credit card applications are up, got to be great for Bankrate. And the stock was a very volatile stock and got whipsawed because of all those little data points that people thought impacted the business. It was less so sort of writ large, but a pretty volatile business and was pretty interesting. And again, the way you get people interested is you go out, you tell the story. One of the things you learn, and I see, and God, I'm going to sound like an old fart, which I am at this point, but I see young people, young CEOs, and think it's never going to catch up to them. It's never going to be 6 months from now. 6 months from now happens really fast, particularly as you get older. And you find out that what you told them 6 months ago is right in your face now. And you've got to tell them the truth. When things are going well, hey, I can't tell you how many times I've tried to talk analysts and investors down from, I know, things look really great. When we came out as a public company, we told the investors that we would run at 20 to 25% growth. First quarter out was 37%, second quarter out was 43%, third quarter out was 47%. And the stock went nuts. And I spent all my time saying, I meant 25%. We're just above the line right now. The line looks like this, we're here. And then, when we've been below the line, you just have to say, listen, we're below the line right now, but the trajectory hasn't changed. If you look at it over a 5-year or a 10-year, it does look like it's kind of up and to the right. If you look at it quarter by quarter, it's a zigzag. And you have to have investors, you have to have analysts, you have to have employees, you have to have a board that understands that volatility. And you do that by, when you get a little bit ahead of yourself, hey guys, we're doing great, but it's going to revert to a more normal growth trajectory. And when it's down, if you really believe and you really know it's coming back, you say, we'll be fine. We're going to be back. We're going to finish the year at 20%. Bankrate this year is finishing a year where we're pretty, flat, slightly down in the first half, killed it in the second half. The investors stayed with the company because we said, we're okay, and we've got relationships and we've got credibility, and we have over time done what we said we'd do. And so when we said we're a little bit out of place right now because of some things we're doing to try to correct and reorganize our insurance business, we'll be fine. We'll grow 30+% in the second half of the year. And as we've reiterated, that's the case, and people have stuck with it and believed it.
So how about the going private part?
It was fascinating. It was a fascinating. I'll give a quick story. So 2005, 6, 7, 8, great years, 41, 47, 72, 80% EBITDA growth. You feel like you're the smartest guy in the world. And I remember specifically in December of 2008, we're finishing the year, fabulous year, almost $60 million in EBITDA, thinking, I can't believe we've gotten through the credit crisis this well. It's not going to hit us. We're awesome. We're the smartest guys in the world. First quarter, we were going to do about 16 or 17 million in EBITDA. Was going great in January, February. March fell apart. We did 13. Now, we'd been talking to private equity guys who are always, hovering around and, well, if you guys ever wanted to buy this or buy that, or when you're a small, cap company, we were, I think, 800 million at the time. You can't go out and make $300 million, $350 million investment. Or if you can, you're kind of betting the farm and it's hard to do. So we had this, you could see all the banks. Our biggest customers are taking TARP money. It was starting to look pretty ugly. Citi, Chase, B of A, all of a sudden canceling their advertising. It didn't take a genius to think, hey, we're not gonna make our numbers. We don't make our numbers, we're gonna get killed. We get killed. You know, now you're a small growth company and you're not growing, you might as well be dead. Nobody's going to pay attention. Nobody cares. They're out, they're gone, and it would take unbelievable amount of work to get it back. So I went back to the private equity firms who had come to us and said, listen, I'll tell you exactly where we are. We thought we'd do 17, we did 13. We thought we'd do 17 in the second quarter. We may do 12. We may do 10. It's going to get ugly. It's going to impact the stock. If you're really interested and can lock in now, we'll take the company private. We can sell it because we're protecting the shareholders. I know I can get the board to agree. And we also thought there were a couple critical assets that if we were right about the credit crisis and we thought it was going to be deeper than it actually turned out to be for our business, longer than it turned out to be for our business, then the critical assets that would become available for sale, primarily NetQuote and creditcards.com, we would not be able to acquire because we'd be kind of nowheresville. And so Apex, there were a couple private equity firms that were willing to do it. They had to work pretty quickly, which is not what private equity firms typically do. And Apex bought the company for, I think, $580 million. So we fell from, and we were already started falling from the 800 that we were at. We sold it for 580. You know, we got about a 15% premium. The stock was trading at 24 and about to go, I thought, to 12. And so, you know, I think we protected the shareholders. We got out, we got private, and our thinking was that we were going to really get hammered, and it was going to be, you know, 24 to 48 months before things turned around. What actually happened, and the other two, so what actually happened is it was about 12 months end to end. We didn't get hit as badly as I thought. We were down about 35% for the year in terms of EBITDA. And we had no debt, very profitable. Cash flows is the same as EBITDA because we're very low in CapEx. And you know, so it was a fortunate thing to be able to get done. The other thing that happened was unbelievably lucky is within the first 100 days of being private, both NetQuote and creditcards.com were for sale. Creditcards.com because they had blown their debt covenants and the company lost the company to the debt holders. And we went in there and scooped that up, which we would not have been able to do had we still been public. And NetQuote then put themselves through a process and we were able to win that process. It changed the company dramatically. When the market turned around, as I said, about 12 months after we went private, we were back on a growth trajectory where we grew over 100%. We grew 70% even acquisition related, even factoring in the acquisitions on a run rate, on a pro forma basis, we grew at 72% coming out. So we got really lucky. We bought the number one assets in each of the two categories, insurance and credit cards, combined them with our number two asset, so we were dramatically the dominant player in both those categories. So we got lucky. The timing turned out to be incredibly lucky. Apex wrote a full equity check for $580 million, so they didn't put debt on because we didn't know how bad and how long it was going to be, and so they made a bunch of dough. The company did well, management did well, and you know, it was a happy story. Interesting as hell. I mean, it was really an interesting process to go through to try to get a company that was a public company and had a pretty good following private.
That's good. It's a good story. So a couple quick final questions in the audience. What makes a good management team? How do you build the culture? What makes a good board member? You know, that kind of stuff. What would be your advice to the young entrepreneurs in the audience? You know,
management team is critical. I mean, having people on the same page, having people that respect one another. I mean, I look for good athletes. I don't care whether they have experience in the space or not. You look at people who are hardworking, smart enough. They don't have to be the smartest guys in the world. Highly ethical with a coachable attitude. You know, and competitive as hell. And I think that the thing that I've seen over time is what makes companies successful is, you know, give me a half-assed strategy because I'm the guy in charge of strategy, so it's half-assed at best. But great execution will always overcome a mediocre strategy. You can have a best strategy in the world if you have crappy execution or poor execution or late execution. It's death. execution is everything. And I think one of the things you learn about tech companies, there are two things that I've thought over time. Number one is you've got to limit the number of things that you're focused on. It's impossible to do 15 things at once. When I got to GeoCities, we had a staff of about 80 people. We had 83 different tech projects in the queue. I kid you not, 83 different tech projects. We were getting none of them done. Big surprise, right? We cut it down to 4, we got those done. We added another 4, we got those done. And everybody focused on, knocking things off. So I see people get, they want to boil the ocean. They want to do so many big things. Doing little things well and doing it every day is really important. The second thing is, I think the hardest thing about being an internet CEO is not to get whipsawed by the flavor of the month. When you think about the number of trends, when I was at GeoCities, there literally was a flavor. The content is king, eyeballs are king, community is king, e-commerce is king. I was sitting at my desk one day in Santa Monica, which is where we were based. I commuted from New York. 7 o'clock, 7:15 in the morning, an investor calls me. It was December of '98, and he says, "Evans, damn it, announce something that has e-commerce in the title." And I said, "Well, we're not an e-commerce company." "I don't care. Announce something." And I think you can get really whipsawed by that kind of stuff, whether it's, when you look at, is it mobile, social, local? Is it buy-side platforms? It can make you crazy if you're trying to catch the wave. And I think board members have to make sure that the company stays true, and I think the CEO's job is just to keep everybody focused and knock things off and just execute really well. I think bank rates, I'd say it's been a mediocre strategy, really well executed. It's a great team, which makes up the fact that we were a little bit weak at the top.
Oh, gotta love it. One question, and then we're gonna move on. Anybody?
The one thing I'd say to you about board members. Go ahead. Good question.
Oh, what are you doing now?
I was going to say about board members. One of the things, I'm on a couple boards and have asked, been regularly asked to be on boards, and I always say, what are you looking for? What skill set are you looking to add to the board? Is it a marketing guy? Every board I've ever seen has plenty of financial expertise. But having a really good audit chairman in this environment is critical. Bankrate's had an awesome audit chairman. He's a professional board member. He was the CEO of a company called Wright Associates, sold it to Manpower. He does the work. He knows what he's doing. It's adult supervision. He's an awesome audit committee chairman. And so when we went out and looked for another, we wanted somebody who really understood, more than we did, sort of marketing. And so we brought in Bruce Nelson, who is the vice chairman of Omnicom. When we wanted to add another board member, we wanted more, sort of digital and other kinds of mobile skill. We brought in Mike Kelly, who was the CEO of the Weather Channel. So I think you've got to look at what kind of skill set do we have here? What do we need to bring in so that we have a well-rounded board so that everybody can contribute? Yeah. Question?
Okay.
Anybody?
Good. Thank you, Tom.
Thank you.
We are going to start the afternoon. Thanks.